Did you know that more than 70% of crypto investors rely only on price charts and indicators, completely ignoring what actually gives a cryptocurrency its real value? Today, I'm diving deep into the world of crypto and challenging myself to supercharge my investment strategy using fundamental analysis. Welcome back to the channel, where we break down crypto investing without the hype and focus on how the crypto economy really works. If you've ever wondered why some crypto projects survive massive market crashes while others disappear overnight, the answer often comes down to fundamentals. So, what is fundamental analysis? It's the process of evaluating a cryptocurrency based on its real-world value, not just its price. Instead of asking, is this coin pumping? We ask, does this project actually deserve to grow over the long term? In traditional investing, fundamental analysis looks at financial statements and business performance. In crypto, it means understanding the technology, the team, the market demand, and the long-term vision behind a project. Most investors today rely heavily on technical analysis. They study candlestick patterns, RSI, MACD, and dozens of other indicators. And while technical analysis is useful for timing your entries and exits, it doesn't tell you what you're actually buying. This is where so many investors go wrong. They buy into hype. They follow influencers blindly. They chase short-term pumps without understanding the underlying value. As a result, they end up holding assets that look good on a chart, but have no real future. Without fundamental analysis, investing becomes guessing. Fundamental analysis helps you invest with clarity and conviction. It allows you to hold strong projects through volatility because you understand why they have value. This is how long-term investors separate the winning projects from the short-lived trends. So, let's break down the key elements of fundamental analysis in crypto. First up is market capitalization. Market cap helps you understand the size, maturity, and risk level of a cryptocurrency. Large-cap coins are generally more stable and established. Think of them as the blue-chip stocks of the crypto world. Small-cap coins, on the other hand, might offer higher growth potential, but they also carry significantly higher risk. Smart investors understand this balance and position their portfolios accordingly. The second element is technology and use case. Ask yourself a simple question. What problem does this blockchain actually solve? Does it offer faster transactions, lower fees, better security, or new functionality that existing solutions don't have? A project without a strong, clear use case is unlikely to survive long-term. No matter how popular it becomes in the short run, it needs a reason to exist beyond just speculation. The third key element is the team and leadership. Behind every successful crypto project is a capable and committed team. Look for transparency, real experience, public profiles, and a clear roadmap. Are the developers known in the industry? Do they have a track record of success? Anonymous teams aren't always a red flag, but transparency definitely increases trust and builds long-term credibility. A strong team is a huge signal of a project's potential. Fourth, and maybe most importantly, is adoption and market demand. This is one of the strongest indicators of long-term success. Real users, real transactions, and real partnerships matter far more than short-term price movements. If people are actually using the network, and businesses are building on it, the project has a reason to exist and grow. Look for active wallets, transaction volume, and an expanding ecosystem. Now, let's look at a real-world example to bring this all together. Ethereum didn't become one of the largest cryptocurrencies because of hype alone. It grew because of strong fundamentals. Ethereum introduced smart contracts, which enabled the entire world of decentralized applications. It built one of the largest and most active developer ecosystems in the world, and it achieved real-world adoption across DeFi NFTs and the broader Web3 space. Investors who understood Ethereum's fundamentals early on were able to hold through massive volatility with confidence. They knew its value wasn't just tied to its price on any given day. Meanwhile, others were distracted by the short-term price swings and missed the bigger picture. This is the real power of fundamental analysis. It gives you the conviction to hold through the noise. Now, here's where things get even more interesting. The most effective investment strategy isn't about choosing between fundamental analyses and technical analyses. It's about combining them. Think of it this way. Fundamental analysis helps you decide what to buy. It helps you identify those solid, long-term projects with real potential. Technica analysis helps you decide when to buy. It helps you find the optimal entry and exit points based on market sentiment and price action. Fundamentals give you conviction. Technical analysis gives you precision. Together, they form a complete and disciplined investment framework that can dramatically improve your results. So, let's quickly recap. Fundamental analysis is your tool for identifying real, lasting value in the crypto market. It helps you avoid emotional, hype-driven decisions and allows you to build long-term confidence in your investment strategy. This is how you navigate the complex world of cryptocurrency with clarity instead of getting caught up in the chaos. Now I want to hear from you. Do you use fundamental analysis in your crypto investing? Or do you rely mostly on charts and indicators? Share your thoughts in the comments below. And if you want to take this further, make sure to watch my next video on technical analysis in crypto, where we'll explore how to combine both approaches for smarter, more strategic investing. Subscribe for more clear, no hype, crypto education. Thanks for watching, and I'll see you in the next video.